Sounds good. Good evening, everyone. David English here from the New Covenant Trust Company. Happy to be here with you all tonight. Thanks for having Andrea and I. We are representatives, as Robert noted, from the Presbyterian Foundation, the entity that is built to serve, started in 1799, one of the longest running charitable organizations built to serve Presbyterian churches. So we are fit to serve the church. Then you have the New Covenant Trust Company that's a subsidiary of that. So we're here to talk about ways, creative ways, that you can use your investments to give to Kingston Presbyterian Church. So that's a little information about who we are. The foundation is a nonprofit entity, and the New Covenant Trust Company is owned by the Presbyterian Foundation. So we are a OCC, Office of Comptroller of Currency, regulated trust bank. So any bank that you'd be familiar with here in Conway or national banks. So we're, set up in a way to work with churches. 95% of our clients are Presbyterian churches just like Kingston. So we feel like we are part of the church. We know the church. We are the church. And so that's who we feel like we're called to serve. The presentation today will be mostly from Andrea. But we do have to hit it with some disclosures, just because we are not offering financial advice, but it's for informational purposes only. We would suggest that you talk with your dedicated accountant or dedicated financial advisor locally. If you don't have one, we're happy to help. But everything you'll hear tonight is for informational purposes only. We'll kick it over to Andrea, and then at the end we'll allow for questions. So hopefully anybody, if you have any questions, we'll be happy to answer.
Well, thanks again for having us. And as David said, we'll keep it informal. If you have questions as we go along, feel free to raise your hand. We can address that at the time, whatever we want to do. So as David said, we're with New Covenant Trust Company, a wholly owned subsidiary of the Presbyterian Foundation. And again, as he said, you can see up here that we serve frequently PCUSA, but we serve some other denominations as well that are theologically aligned with PCUSA, churches, mid-councils, schools, colleges, seminaries, organizations, you name it. That's our typical client. That said, we also serve individuals and families. We offer trust services. And anything we make, any profit New Covenant generates, goes back to support the work of the foundation, which is our parent company. And I'll go over at the end a little bit more about the foundation and how they support the church nationwide. So with that, let's see. So this evening, I'm going to talk mostly about qualified charitable distributions. And many of you may be familiar with this, so if it's review, sit back and relax. But basically, a qualified charitable distribution is a way to make a charitable gift from your IRA that comes with some fantastic tax benefits and is very convenient to do. So it's an otherwise taxable distribution that would come from your IRA, owned by an individual who is age 70 and a half or older, and paid directly from the IRA to a qualified charity. So we'll go over some of these requirements for it. Again, it's an otherwise taxable distribution. We'll get to some of those requirements. For a traditional IRA, of course, typically a traditional IRA, your dollars go in there when you're working. They go in before taxes. They grow tax-free. And when you retire and begin to draw money out of your IRA, it becomes taxed to you as your income, just like your other income that you receive while working. So that is otherwise a taxable distribution to you. QCDs were created by the Pension Protection Act of 2006, along with some other tax advantageous type gifts. That authorization was renewed several years, and in 2015, Congress made this type of gift a permanent way to give. So Again, it's very convenient, a lot of tax benefits with it. So, top requirement, again, is it must come from a traditional IRA. That means not a SEP IRA, a simple IRA, a 401k, or a 403b. You can do them from a Roth IRA, although in your Roth IRA, those dollars are post-tax. So it doesn't make as much sense, and you don't derive the tax benefits as you would if you're getting that distribution from your traditional IRA. And again, has to come from an otherwise taxable distribution. The distribution must go directly from the IRA custodian to the charity. So you as the IRA owner and donor to charity would not ever receive that money yourself. You would, as a client of NCTC, you would contact whoever takes care of your IRA. They would reach out to David or some other folks at NCTC who would say, okay, here's instructions for transferring that to us. And because you are a client of NCTC, we can receive those funds as your gift into your account you hold with us. Is all this making sense so far? Yes. If you have, say, a Roth IRA that's post-tax, you wouldn't want to move that to traditional. 401k, yes. And so if you have one of those, and as you near retirement, most folks will begin consolidating those from their employer into an IRA. So yes, when you retire, it has to come from that IRA, but certainly you can roll funds from one qualified account to another. Yes. Is that making sense so far? Otherwise, okay. So the other end of the requirement is the charity must be eligible to accept it. Now that doesn't mean just that we have the capability to accept it, which if you give it to your church, then we do. But it typically means it has to be the right kind of organization. So that's usually a 501c3, nonprofit, public charity, a church, religious organization. There's some other kinds of organizations that are not a 501c3 that would still be eligible to receive those gifts, like private foundations, political organizations, civic leagues, social clubs, business leagues, some of those types of, Fraternal Order of Eagles or whatever it might be. A qualified charitable distribution cannot be contributed to a donor-advised fund. And I'm going to talk about those briefly, a little bit deeper into the presentation. Donor-advised funds could be a whole presentation on its own and how they function, so we're going to just scratch the surface. The long and short of it is, as you might guess, the IRS, knowing that your money has been growing tax-free in your IRA, they want at some point for you to take that money out and pay taxes on it. If you give it directly to charity, you're not doing that. If you're giving it to a donor-advised fund, similarly, it won't be taxed, and those donor-advised funds can be used in a way that the funds can be there longer. Therefore, the IRS does not like that. They would really like you to get those funds somewhere to be taxed or give them directly to the charity beneficiary. So IRA owner must be age 70 and a half or over when they make this distribution for it to qualify as this charitable distribution. There's you can take IRA distributions earlier than 70 and a half, and when you are older than 70 and a half, you'll be required to take those IRA distributions, but 70 and a half is the mark for being able to use them for a charitable purpose. So we'll go through some of those ages again in a minute. Currently, the maximum annual amount for each taxpayer to make a qualified charitable distribution is $105,000 per person annually. That just last year began being indexed for inflation. So next year, that limit will be $110,000 per person. This amount does not apply. So typically, when you make a charitable gift, if you itemize, your total charitable giving is limited to 60% of your adjusted gross income. So after you've adjusted your income on your taxes, you can take up to 60% of that in charitable deductions. If you can't take all the deduction you're entitled to within that 60%, you can carry that deduction forward. A qualified distribution from your IRA does not count toward that 60% cap because it's not income. So it's not a deduction. You never receive it. So you're going to avoid taxes by not receiving it as income, if that makes sense. Okay? So that's another kind of advantage if you're someone who is very generous and charitable. Let's see. So qualified distributions do count toward a taxpayer's required minimum distribution in the year it's made. Now, if you all in the audience are retired, you probably are familiar with the required minimum distribution from your IRA. But that is the age, which is currently 73, at which you are required to begin to take a certain amount of funds from your IRA each year. Again, the IRS wants you to withdraw those at some point so that you will be taxed on them as they've been growing tax-free. So definition here, required minimum distributions or minimum amounts that an IRA owner must withdraw annually beginning April 1st of the year following the year in which they turn 73, because the IRS also cannot say anything in fewer than 100 words. But that means if you turn 73 in 2024, by April 1st of next year, you must begin taking those required minimum distributions. And those are figured by basically a tax table. And so an accountant or tax preparer can tell you you're going to have to start taking this amount each year. So here are those pertinent ages. You can begin taking distributions from your IRA as income as early as 59 and a half. You have to be 70 and a half to use them for a charitable purpose, and you must begin taking them currently at age 73. Okay, that last age, by the way, that's currently 73, over the next, I don't know, several years, the next 10 years perhaps, it's going to go up incrementally until that amount gets closer to 80. The IRS essentially is pushing that forward as people live longer. So again, that amount that you use that goes directly to charity is not in your gross income. So it doesn't go toward your deduction because you never take it. Why would you not want income? I know that's usually the first question that comes to my mind. Why would you not want the income? But if you are retired, first of all, Medicare, Medicaid, SSI, some of these supplemental benefits have very strict income caps. So if you are at an age in which you have other sources of retirement income and you are required now to take that IRA distribution, it can push your income over a limit that would jeopardize some of these supplemental benefits. Also, again, you're not paying tax on that, so in retirement, kind of reduces your tax bill as you're giving to charity. And if you don't itemize, it provides a nice tax benefit without having to do so. So, of course, anytime you make a gift to charity, if you itemize on your taxes, you can deduct those charitable gifts. If you don't itemize and you take your standard tax deduction, this is a way that you can give that to charity and avoid those taxes without having to itemize. So, quick little example of what that looks like. We're going to make a $1,000 gift that's going to come out of our IRA. We're going to make it to Kingston Presbyterian Church. If you are in the 24% tax bracket, which is about right in the middle, that's $240 of federal tax that you would not pay. Additionally, South Carolina state tax is 6%, so that's another $60 of tax that you will not pay, which means you are avoiding I shouldn't say avoiding, that would be really frowned on by the IRS, they really don't like that. You are saving tax dollars at $300, which means your $1,000 gift actually costs you $700. So it's a way that you can give more with really less expense to yourself by utilizing that IRA to make the gift. Now, I'm going to diverge for a moment, not divulge, diverge. With this tax savings, you're able to give more, or you can say you're able to give the same amount of a gift at a lower cost, so to speak, to you. There are a couple other handy-dandy ways that you can make gifts that also result in some tax benefits. They're really simple. So again, we're going to scratch the surface on those. First of all, hot tip number one, appreciated assets. So in this instance, we're talking about non-IRA assets. So outside of your IRA, you may have an investment account. You may have some mutual fund shares. You may have some other assets, some typically stock, but stocks and bonds, that have been growing and appreciating over time. If you were to withdraw those assets out of an investment account, you would be taxed on the amount of capital gains, which means, well, we'll go through a quick example here. So typically, again, we're talking about non-IRA securities. Another instance where you give them directly to charity, so you're not going to receive it. We're making another $1,000 gift, and we're going to say you have $250 of cost basis, which means when you acquired that, when you bought that stock, those 10 shares, let's say, they cost you $250. Well, now those shares are worth $1,000. So if you withdraw that, you are going to pay capital gains on $750 that money has grown. At the 15% capital gains tax rate, that is $112.50 that you'll not pay if it goes to charity instead of you. So again, now we've got a $1,000 gift that actually costs $887.50. So not quite the same cost difference as with the QCD, but anytime you're giving something that is not cash, there are typically benefits like this. Anything that is not cash, that has appreciated in value. And again, you can do that for your church here because as a client of NCTC, we can support the church in accepting things like, 12 shares of Apple stock or whatever it is you own. You can actually donate that stock directly to the church with NCTC support. So if you ever want to do that, you contact the church, and they're going to get in touch with NCTC, and we will connect with your broker to give them instructions on how to do that. Okay, so hot tip number 2, I mentioned before, donor-advised funds. Does anybody are familiar with donor-advised funds, know what they are? Does anybody have one? Anybody? So I think they're really pretty cool. Essentially, I'll pull this up here. Essentially, donor-advised funds work like a charitable checking account. Okay, so you can contribute money to a donor-advised fund, and you can decide later what charity it's going to go to. Donor-advised funds are held by a fund sponsor. A lot of community foundations, that's really kind of where donor-advised funds kind of had their creation. There are also commercial donor-advised fund sponsors. You'll see Fidelity Charitable or Vanguard Charitable or some of these others. The Presbyterian Foundation also has a donor-advised fund that they're a sponsor of. When you give to a donor-advised fund, you are actually making an irrevocable gift to that fund sponsor, whether it's the Community Foundation, the Presbyterian Foundation. That's a nonprofit entity, and you're making an irrevocable gift. But the agreement with that sponsor is, okay, we're going to hold the funds, we're going to invest the funds. You can actually advise us on how you want us to invest them to grow, and then you also retain the right to advise where you want that to go. So while it is an irrevocable gift, you no longer own those funds. What you can do is tell the fund sponsor, hey, I'd like $100 out of my fund to go to my church, or I'd like $50 a month out of my fund to go to this church, to my favorite charity, to wherever. So like I said, you can give now, decide later. When you give the money to a donor-advised fund, you get your tax deduction when you give it. So it allows you, say, at the end of the year, you're looking at your tax bill and you're like, I'd really like to make some more charitable gifts. I don't know where I want it to go yet. You can give them to a donor-advised fund, and then next year recommend where you want money to go. Okay? So it's a really nice convenience. I know our CEO tells the story. She has a donor-advised fund at the Presbyterian Foundation. They had a year in which her husband was taking a buyout from his company, and it happened in December. So suddenly in December, they're going to get an influx of dollars, which is a great problem to have, except that there's no time really to give that away, mitigate taxes, not a lot of time to plan for that. So they took a chunk of it and put it in the donor-advised fund so that their tax bill was not out of control, and they can decide later where they want those funds to go. And then they recommend a grant to the charities of their choice. You can use it with other gift vehicles. Things like at NCTC, we hold trusts for folks. And David and I are actually working with a client now who has created a charitable trust where they get income from life for life, and at the end of their lives, what is left in the trust goes to charity. And in this instance, what is in their trust will go to a donor-advised fund at the Presbyterian Foundation. They can name a family member to continue advising that fund. They can have it distributed to various charities. So it's a really versatile tool. And there are no age restrictions or anything like that on the donor-advised fund. Most community foundations, like I said, hold them. And often the investment minimum starts anywhere typically from, say, $10,000 to $25,000, which is a lot for most folks. At the Presbyterian Foundation, you can actually open a donor-advised fund for $2,500. So it's a fairly lower entry point for starting that. It's a great way to involve family in your charitable decisions. Like I said, that's probably a whole different presentation, but I want to make you aware of those. They're pretty cool. It's a nice tool. It would be, yes, it would be, correct. It would be as if you gave it directly to a charity. Now again, remember, we can't do a QCD out of your IRA to a donor-advised fund. You can, however, give appreciated securities, stocks, bonds, your appreciated assets, and you will get that a tax break on the capital gains for those investments. So that's another great way to utilize that. Okay, that's a good question. Thanks. All right, so back to our QCDs. Like I said, these were fairly recently made permanent in 2015. So in terms of kind of what the outlook is going forward for how those can be used, as of last year, Congress passed the Secure 2.0 Act, is what it's called. They expanded the use of a qualified charitable distribution to certain types of gifts that are life income gifts. So you heard me mention a charitable remainder trust. There are also gifts, charitable gift annuities. Generally, those types of gifts are gifts that, again, will be contributed under an agreement. It will pay the donor payments for their lifetime, and at the conclusion of that, what is remaining goes to charity. So those are life income gifts. And last year, Congress said, okay, you can use a QCD in some very limited circumstances. You can fund a charitable gift annuity or a charitable remainder trust. But there are limitations on that, and they've left some questions unanswered that we're not sure about yet. So they limit it very narrowly to $53,000 a year as of this year. And again, that's indexed for inflation again, so that will go up each year. It can only be done once in a lifetime. So that is the only, you can do it once and that's all. So not once a year, once in a lifetime, $53,000. Once you have created that gift instrument, you cannot add funds to it. So typically a charitable remainder trust, you can continue adding funds if you want. Not if you use a QCD. You cannot add anything to it. They cannot be used on what we call deferred annuities, which is when someone enters a gift annuity agreement and says, yeah, but I don't want it to pay me for another 10 years and then it can start paying me. Can't use it that way. So it's very limited circumstances. And as a practical matter, almost never are used for charitable remainder trusts because trusts can be expensive to administer. And honestly, while that is a great deal of money in terms of trust administration, it's a small amount. And the trust administration will begin to eat into your principal, which you don't want. So what we don't know yet, it's not clear. I don't know when the IRS will ever make it clear. We don't know if spouses can combine their $53,000 QCDs to make $106,000 trust or annuity. Not clear. There's speculation that, yeah, maybe because I believe it says qualified distributions in the regulations, so that's all we know. So we think, but maybe not. The other question is, you'll recall earlier, the most you can contribute with a QCD or with QCDs in a year is $105,000. So if you do one of these kind of gifts, does that count towards that $105,000 limit? Or is it in addition to that limit? And we don't know that yet either. And again, it's completely unclear. So this is very new, but very limited and kind of murky. So that's about all there is to know about that. The last slide, as I mentioned before, our partner, our parent foundation, our parent company, Presbyterian Foundation, as we saw before, all of our profits go to that foundation. Basically, the work of the foundation is that they take in gifts, investments from donors in the form of permanent endowment funds, pooled income funds, and donor-advised funds, which we talked about. They take all this in, they manage it, and then resources go out to the church in the form of financial tools, stewardship resources, stewardship advising, plan giving tools, ministry partnership funds, which can do things like allow churches to receive online donations or receive stock donations. And then they support New Covenant Trust with their referrals, with operational support, and like I said, in turn, then our profits go to them. So whenever you work with New Covenant Trust, any profits are going always back into the work of the church. So good thing to know. And that is the long and short of what we have. If anyone has questions, feel free. Here's our information. If you have questions you want to follow up on, please do. Any other questions? I know taxes and stuff is riveting. But also if it can save you some money, it's kind of nice. Save money and do some good work with your resources too. So we have some hard copies we floated around, and we certainly can email this out. Any other questions? Thank you for having us. We appreciate being here. Absolutely. I'll leave that up. But thank you. Thank you very much. Thank you for having us.
Let me close with a prayer and we'll get on our way. Let's pray. Holy gracious God, go